Alright, today we're going to talk about volatility. We're going to discuss why volatility happens and some of the factors that cause this to happen. First, we're going to talk about circulating supply and availability of supply. When you measure market cap, and remember from the previous video that you have your supply in circulation times your price and you get your market cap. Part of the problem with that is people make the assumption when the market cap goes up. For example, I buy a new coin and just one coin, but maybe there was 100 coins in circulation. That means that now all of those coins are worth that value. That's what the market cap is doing. It's saying you bought one coin at $10. Now we're going to take all the rest of the coins and we're going to say they're worth $10. But it doesn't necessarily mean that there's a buyer at $10 for every single one of those other coins. So what ends up happening in cryptocurrency markets is as people start to get excited, people start to hold on to their coins. They don't want to sell them. They want to hold it to a higher value. What that does is it makes it so that instead of saying 100 coins are trading, we could have an example where, we've got a few coins and these are the only coins that are being traded. So this coin goes from me to someone else and then back to somebody else. You actually only have maybe a dozen coins that are just changing hands over and over again. The rest of the coins aren't moving. And what this does is it illustrates buyers on a small portion of the asset versus buyers on a huge portion of the asset. So it can create a market cap that's much larger than the amount of capital that's come in. So it may only take $1 million to make the market cap go up $10 million, for example. There's actually many charts in the past made about this, how much the price would go up for even small amounts of money, depending on how many coins were available for purchase. Another factor that we should look at is leverage. So what happens with leverage, when I only have the money to buy one coin, I actually can take a loan and maybe I buy 10 coins. So not only do we have a shortage of coins, but now I'm taking 10 of those coins, but I can only afford one. So what ends up happening on the other way is liquidation. Now the guy who could only afford one coin now has to sell 10 coins back into the market because doesn't have the money for any of it, gets liquidated. So those coins get dropped out of the market much faster than an individual who, for example, could afford one coin, bought one coin, and actually at no time has to sell that coin because the money that they used to purchase it, there was no loan involved. So there is no potential for liquidation. They can just hold that as long as they'd like. Whereas the leveraged individual gets forced into liquidation and switches from being a buyer to being a seller and causes even more push down in the price. This is part of why we see these huge, multi-100% increases in crypto assets and then these huge pullbacks of 50% false or even 80% false in some of the smaller coins. And then there's another factor to consider. The other factor is that cryptocurrencies are the fastest growing technology in history. By being the fastest growing technology in history, you have a lot of new participants. The growth is actually outpacing the growth of the internet. So there's so many people coming in trying to buy that there's a huge influx. When that influx of people stops being exponentially larger, so at the beginning you have 10 and then later months you have 20 people and you're not actually gaining huge amounts, you start to gain only a few percentage points of extra people, that removes momentum. So to revisit what we talked about, we have lack of supply of coins. This causes upwards and downwards movement when the supply gets put back on. So a lot of people, when the price gets to a certain point, tons of coins can get dumped back onto the market at that price, causing the price to drop dramatically quickly. We have leverage and liquidations effects, so the upward effect of leverage and the downward effect of liquidations. And then also at the same time, we have user growth. So as people start to notice the price going up, they get interested in a technology. Some of those people stay, some of those people leave. But at the end of the day, the price effect is the influx of people coming in. They create a demand side that outpaces the supply side, which is just simple supply and demand economics. Thanks for watching the video. Please like and subscribe. And if you have any comments, please leave them below.